All right, welcome back to the deep dive. Today we're going to zero in on something that I think really hits home for everyone listening, your water bill.
Yeah, that's a big one.
It is a big one. And we're all feeling the pinch these days. We're going to specifically dive into some early thinking from Ofwat, that's the water regulator, just in case you're not familiar, on how they're approaching a really key concept called the weighted average cost of capital. We'll call it WACC for short.
WACC.
And this is all for their big upcoming price review in 2024. The outcome of that review is ultimately going to shape how much you and I and everyone else pays for their water.
For sure. And we've got some great sources to really dig into this with.
We do. Two really interesting reports, both commissioned by the Consumer Council for Water, the CCW. They've really gone in depth to examine Ofwat's initial thinking on this whole WACC thing.
Yeah.
So before we get too far into the weeds, let's do a quick level set. WACC, what is it exactly in plain English?
So think of it this way. It's basically the rate of return that Ofwat reckons water companies need to be able to attract investment. And that investment is what pays for, everything, fixing those leaky pipes, upgrading treatment plants, making sure that the water coming out of your tap is clean and reliable.
Essential stuff.
Yeah. The higher Ofwat thinks it costs these companies to borrow money and attract investors, the more they're likely to let them charge you, the customer, to cover those costs and, of course, still make what they consider to be a reasonable profit. So, bottom line, WACC, it has a pretty direct impact on how big your water bill is.
Straight to the point. So our mission today, dear listener, is to figure out, are Ofwat's starting assumptions about this cost too high? Are they inflated? Because if they are, it means you could be paying more for your water than you really need to.
Right. And that's what these reports are getting at.
Exactly. We're focusing on two key documents today. One is the CCW Review 2023.pdf, and the other is a peer review of what? PR24 WACC allowance.pdf by MCC Economics.
MCC Economics.
Both of these reports offer some really compelling insights and perspectives.
They do.
And here's something to grab your attention straight away, right off the bat. These reviews suggest that Ofwat's initial take on the cost of capital, it could be a bit off, a bit of an overshot.
Potentially.
By a significant amount. As much as £2.6 billion, actually, over just the next 5 years.
2.6 billion.
2.6 billion. That's a huge number.
It is.
What's more, that translates to a potential saving for your household, for the average household, of around £20 a year.
£20 a year.
Just from this one little calculation.
Yeah.
It's pretty eye-opening. Okay, let's unpack this a little bit. The reports talk about something called cross-checks. What are these, and why are they so important when we're trying to get to the bottom of what the right WACC should be? So Ofwat mainly uses what they call a bottom-up approach to estimate WACC. And their main tool for this is the Capital Asset Pricing Model, the CAPM. But the reports make the point that Ofwat could also be using, top-down methods. They call them cross-checks. They're like reality checks. It's where you look at what's happening in the financial markets, to see if Ofwat's estimates, these theoretical estimates for WACC, actually stack up in the real world, like getting a second opinion, but from the market itself.
Right. That makes sense. What makes these cross-checks so valuable then? What can they tell us that Ofwat's primary approach might be missing? Okay, well, for one thing, they provide a vital element of independence, right? Because they're not based on Ofwat's own sort of prior assumptions or on all the complexities that come with the CAPM model itself. They're also separate from any lobbying or vested interests, whether that's coming from investors or from the water companies themselves. And really importantly, cross-checks, they reflect actual market prices. So we're talking about what it actually costs to raise capital, both debt and equity, and also what investors are willing to pay for similar assets, comparable sectors like energy or infrastructure.
So it's like checking if the price tag of Ofwat is suggesting actually aligns with what these things really cost out in the open market.
Exactly. Now, the reports point out that Ofwat does use some cross-checks already. Primarily, they look at market-to-asset ratios, MERs, for water companies that are listed on the stock market. But here's where things get interesting.
Okay, tell me more.
Ofwat tends to dismiss MAR data from transactions that involve private water companies.
Why would they do that? I mean, surely what someone's actually willing to pay to buy an entire company is really relevant information.
Right, you'd think so. But Ofwat's argument is that private deals could be distorted, by things like, for instance, the winner's curse, where the buyer might overpay in, a really competitive auction, or by control premiums, which are extra sums paid just to gain full control of a company. They prefer to stick with what they consider to be cleaner data from the public stock market.
Cleaner data.
Yeah. But The report suggests that this might be a bit of a departure from Ofwat's previous approach, actually.
Oh, really?
If you look back at the last price review, PR19, Ofwat did consider private MRs. They even referenced examples like the 15% premium that was paid for affinity water.
Yeah.
So it seems a bit inconsistent to now largely exclude them. The reports also highlight that the UK Regulators Network, that's a body that promotes cooperation between the different utility regulators, they don't actually take a firm stance on whether public or private MRs are better indicators. They even mention Pennon's acquisition of Bristol Water at a, get this, 44% premium as potentially useful market evidence.
44%.
Yeah,
That really suggests that investors saw a lot of value above and beyond what was on the books.
definitely. And the reports then draw a contrast with what the Australian energy regulator, the AER, does. They see these sorts of cross-checks as super valuable for making sure that, their theoretical calculations are at least in the right ballpark.
So other regulators out there are seeing the value in looking at these real-world deals.
Yeah, absolutely.
What about closer to home? How does Ofwat compare to Ofgem on this issue of MEMRs? Ofgem being, of course, the energy regulator.
That's another really important point. Ofgem does include private transactions, like that Penn and Bristol water deal we talked about, when they're analyzing errors. And this difference in approach actually leads to quite different conclusions about the implied cost of equity. Ofgem's figure tends to be lower when you factor in those private deals.
It's interesting. So the way you decide what market data to include or exclude has a real impact on the final figures you come up with.
A big impact, yeah.
The reports also dig into a particular assumption that Ofwat makes, and it's the assumption that if water companies consistently outperform their allowed returns, and they assume this goes on forever, that this is somehow consistent with their CAPM calculations. Now, Ofgem, on the other hand, they don't make that same assumption of perpetual outperformance. And this affects how they interpret what the MERs are telling them about the cost of equity.
Right.
The report actually questions whether Ofwat is even comparing apples with apples here. We've got one scenario where a fair return is expected and another scenario where outperformance is built into the model right from the start.
That's a key distinction.
Yeah. If outperformance is already expected, then maybe the allowed return doesn't need to be set quite so high in the first place.
Exactly.
Now, this brings us to another concern that's flagged in the reports, which is the pretty significant 11% increase in Ofwat's allowed return on capital between 2019 and 2022.
11%.
The question the reports pose is, if market signals, from those MERs we were talking about, if those signals suggest that returns are already adequate, what justifies such a big bump?
Yeah, that's a big jump.
It is a big jump. So based on all of this, what kind of broader cross-checks do the reports recommend that Ofwat could be using, to get a more complete picture of the situation?
Well, they suggest looking at what Ofgem does, for example.
What does Ofgem do?
So they look at a much wider range of market signals. They include, for example, something called the Modigliani-Miller cost of equity, also the MAR implied cost of equity from those private deals we discussed, the implied returns from companies that run offshore electricity transmission links. They're called OFTOs.
Okay.
OFTOs, yeah. They even look at views from investment managers and, the returns that infrastructure funds are actually achieving. The reports also suggest that Ofwat could try to estimate a pure CAPM WACC. There was a study done by the UKRN back in 2018 that outlined how to do this. Essentially, it involves simplifying some of those more complex assumptions.
Okay.
And finally, they recommend that Ofwat, takes a closer look at what their international counterparts are up to, particularly the AER in Australia. Compare notes, look at the methodologies, look at the results, and see what can be learned.
Makes sense. More ways to double check their work, basically.
Harmony.
Okay. Let's shift gears a little bit and talk about debt now, how water companies finance themselves. This is another area where Ofwat's initial thinking might be open to some debate.
Yeah.
Here's where it gets really interesting when we're trying to understand what the potential impact could be on your water bills. The reports reveal that, between them, water companies raked in a cool £2 billion in something called financing rewards. This was in the 7 years leading up to March 2022.
$2 billion.
$2 billion. A lot of money. What are these financing rewards?
Yeah, good question. It's kind of a catch-all term in their reporting that covers several different financial benefits companies have received. This includes things like having lower debt levels than Ofwat had assumed they would, variations in corporation tax, tax relief within company groups, the actual cost of their debt versus what was allowed, and the impact of any financial hedging they've done. And importantly, these things are often based on assumed levels of equity, not necessarily the actual equity that companies hold.
And £2 billion. The reports make it clear that this dwarfs the financial impact of other performance incentives that are in place in the water sector. Things like incentives for customer service or environmental improvements.
Much bigger.
While companies might have faced some penalties in certain areas for how they operate, the financial gains from these financing rewards were overwhelmingly positive.
For sure.
The reports also highlight a potentially important detail. The bigger water companies, the larger ones, they tended to get the biggest slice of these financing rewards.
Oh, interesting.
So just looking at a simple average across all companies might actually underestimate the overall financial impact of this. Now, let's zoom in on something called gearing. Ofwat currently assumes a notional gearing level of 55% for all of these calculations.
55%.
The reports question whether this assumption should actually be lower.
Lower.
Now, why is that significant? Explain it to me.
Okay, well, gearing, simply put, is the proportion of a company's financing that comes from debt, as opposed to equity.
Debt versus equity.
Right. A lower assumed gearing level basically means that Ofwat thinks that companies are using less debt to fund their operations.
Got it.
And there are a few reasons why the report suggests that 55% might be too high. Firstly, we've had high inflation recently, right? The regulatory capital value, that's the value of the assets that they're allowed to earn a return on, that's grown pretty rapidly.
With inflation.
Yeah. And this growth in asset value, well, it could potentially be funded by equity, especially if returns in the sector are looking good rather than going out and taking on more debt. Secondly, the reports remind us that back in the good old days, the 1990s, in previous price control periods, PR94, PR99 of Ofwat actually used a lower gearing assumption. They used 50%.
50%.
And thirdly, the market-based evidence, those MR ratios we were talking about earlier, they also suggest that the actual level of gearing in the sector could be about 10 percentage points lower than Ofwat's current 55% assumption.
So maybe 45%.
Yeah, potentially.
Interesting. So if they are actually relying less on debt, well, that has implications for the overall cost of capital.
It does.
What about inflation-linked debt? Ofwat assumes that 33% of water companies' debt is linked to inflation. But again, the report suggests this figure might be too low as well. What's the thinking behind that?
Okay, so the actual proportion of debt that companies have that's linked to inflation is already higher than that 33%. And then when you factor in things like swaps, which essentially convert fixed-rate debt into inflation-linked debt, that proportion could be more like 60%.
60%.
And this trend is likely to continue as companies make decisions about refinancing their debt in the future. So Ofwat's 33% assumption could be way off.
It seems like the picture of how these companies are actually financed is more complex than Ofwat's initial assumptions would suggest.
It's nuanced.
What about the actual cost of that debt? Ofwat is currently allowing a real return of 2.6% on debt. Now, the reports lay out 8 different signals that suggest this allowance might be too high.
8.
That's a lot.
It's a lot to unpack.
It is. Let's touch on a few of the key ones.
Okay, well, one really important point they make is about Ofwat's own calculation for embedded debt. This is basically the average cost of the debt that water companies already have. And their own figure for this at 4.38% in nominal terms is already at the upper end of all the evidence they've considered.
Upper end.
Yeah. Another concern is around potential errors or inconsistencies in how Ofwat is actually modeling that cost of debt.
Okay.
They give a specific example where there seems to be a mismatch in a loan forecast for Southern Water compared to what the company itself reported.
So they're not matching up.
Not exactly.
Yeah.
And that could have a knock-on effect on the final cost.
Yeah.
They also question some of the assumptions around debt tenors. That's the length of time before the debt has to be paid back. Generally, shorter-term debt is cheaper than longer-term debt. But the report suggests that Ofwat's adjustments to account for shorter tenors, they might not do enough. They could be overestimating the cost there.
Okay.
They also make the point that Ofwat isn't fully taking into account cheaper forms of short-term capital that companies do use.
So they're potentially missing out on some of the cheaper ways that companies can get financing.
Exactly.
All right, well, what are some of the other signals?
They suggest that Ofwat might be overestimating the amount of new debt that companies will need to issue. That new debt is assumed to be more expensive than their existing debt. They're also using an inflation assumption of 2% in their calculations, even though market forecasts and official forecasts are generally higher than that. And a higher inflation rate would mean the real cost of debt would be lower. They're also using a historically high RPI wedge. That's the difference between RPI and CPI inflation. They should really be using a lower market-based forecast for that difference, the reports argue. And lastly, they're assuming that all debt that has to be repaid before 2030 will be refinanced at a pretty high interest rate, which might not be realistic.
Okay. So it sounds like a whole bunch of individual assumptions within the debt calculation could be nudging that allowed cost higher than it really needs to be.
Yeah, potentially.
Let's move on to the risk-free rate, the RFR. Ofwat's initial view is a real RFR of 0.47%. Again, the reports point out some reasons why this might be a little high.
A little high.
Talk me through it.
One important thing here is how long Ofwat is averaging historical data to work out the RFR. They're using a 1-month trailing average, which is pretty short.
2 months.
Other regulators like Ofgem and the CMA, they tend to use longer periods, 6 to 12 months typically.
So smooth out some of those bumps.
Yeah. Using a longer average would smooth things out and likely lead to a lower overall RFR. They're also using a 20-year tenor, or maturity, for the risk-free rate. And, longer-term rates, they tend to be higher than shorter-term rates. Interestingly, Ofwat used a shorter 15-year tenor in the last price review.
So switching to a longer tenor means they're inherently picking a higher starting point.
Yeah, basically. There's also some uncertainty around a potential move towards equity indexation. Now, this is a bit technical, but it could change how risky investors see this sector. And the reports raise the concern that Ofwat might not adjust the equity beta accordingly.
Equity bit, we're going to get to that later.
We'll get to that, yeah. And they point out that there hasn't been much discussion with stakeholders about this potentially big change, especially if it's introduced late in the game. Finally, if you look at evidence from SONIA swaps, that's a benchmark interest rate, and you adjust it for inflation expectations, you get much lower estimates for the risk-free rate compared to Ofwat's current method, which relies on index-linked gilts.
So other ways of looking at this, maybe more up-to-date ways, suggest that Ofwat's number might be inflated.
Yeah.
Let's talk about the total market return. The TMR Ofwat's midpoint assumption here is 6.46% in real terms. And once again, the reports have identified 8 signals suggesting this might be too high.
8 again.
8 again.
There's a theme emerging here.
There is. So one of the first things to note is that Ofwat's own range of estimates for the TMR is at the very top end of all the evidence they've considered.
Right.
They've also chosen to use what they call the CPIH backcast for inflation. CPIH is a measure of consumer price inflation, but some people argue it's not the most appropriate inflation measure to use for every single historical period. Ofgem, for example, has steered clear of using it for certain types of data.
They have.
So even the way you choose to measure inflation in the past can affect your estimate of future returns.
It can.
What about looking forward? Are they taking future expectations into account?
That's another one of those signals. Ofwat has chosen not to use forward-looking TMR evidence. This actually goes against guidance from the UKRN and also what both the CMA and Ofgem are doing.
They're all looking forward.
They are. They consider forward-looking data, which currently suggests a lower TMR.
Okay.
Ofwat's also excluding what they call non-overlapping estimates. And these also tend to point to a lower TMR and are designed to prevent overweighting the same data.
So it seems like they're making choices that are leading to a higher estimate.
That's the takeaway, yeah. The reports also point to potential errors in how Ofwat is calculating arithmetic returns from the data, compared to what the CMA does. They also suggest that Ofwat should be looking at data from Barclays, which seems to give lower TMR results compared to the data source of Ofwat's using. They also assume that the TMR is more stable than the market risk premium, that's the extra return investors expect for taking on the risk of the stock market. This assumption goes against what a lot of international regulators think. Finally, the reports warn Ofwat not to make the same errors as the CMA did, specifically in how they treated these non-overlapping values and the use of the same inflation measure for both past and future periods.
It sounds like there's a real debate about the best way to estimate the TMR, and the way Ofwat is doing things seems to consistently push their number higher. Now, let's tackle equity beta. This is a measure of how much a particular stock's returns move up and down compared to the overall market. Ofwat's midpoint assumption is 0.61. The reports flag 4 signals that this might be too high.
Too high.
Walk me through it.
Okay, first up, the range of beta estimates that Ofwat has looked at the midpoint of that range is right at the top end of their own analysis.
At the very top.
At the very top. Secondly, they haven't published or used results from some more Well, let's say advanced statistical techniques like Gersage. Gersage can account for changes in market volatility, how much prices fluctuate over time. Ofwat's just relying on a more basic method called ordinary least squares, even though their own advisors actually used Gersage in the previous review.
So simpler tools.
Simpler tools.
Maybe not capturing all the nuances.
Yeah. Now, for the third point, let's talk about the data they're using for the different water companies. Ofwat's excluding the beta data for Pennon, this one of the listed water companies. And they say they're doing this because they're concerned about Pennon's cash balance and a perceived lack of what they call unaffected data. But the reports argue that a company's cash balance shouldn't really directly impact its raw beta. This is a measure of how sensitive it is to the market. Right. And this exclusion raises questions about consistency. Would they exclude other companies for having large cash balances? And are they potentially downplaying more recent data that shows lower betas for the whole sector? Good point. And finally, how Ofwat averages beta data across different time periods using those 2-year and 5-year trailing averages of 5-year and 10-year betas, and the fact that those samples overlap, well, it might be giving too much weight to certain periods in history without a clear reason. So you put it all together.
It does seem like across the board, from the cross-checks, assumptions about debt financing, that risk-free rate, the total market return, even equity beta, these independent reports are saying, hang on a minute, is Ofwat's initial thinking about the cost of capital too high?
Yeah, that's the big question.
And they don't stop there, do they?
They don't. The reports go a step further, and they try to work out what the potential impact of these overestimates could be for consumers. They suggest that if Ofwat were to swap their early view for what they call a more market-led view of the cost of capital, it could shave something like 0.54% off the overall WACC.
Okay. And what would this market-led view look like in terms of the stuff we've been talking about?
Okay, so you'd have a lower notional gearing down to 50%. You'd use Ofgem's implied cost of equity from their MAR analysis, which is about 3.5%. And you'd have a lower allowed return on debt at 2%.
And what's the bottom line here? What kind of savings could we be talking about if all of these adjustments were made?
They estimate that this market-led view could save customers a total of £2.6 billion.
There it is again.
Over the 5 years of the next price review. And that works out to roughly £20 per household per year.
£20 per year per household. That's real money.
It is. And it shows how these technical kind of regulatory assumptions can really affect people's lives.
So to sum it all up for our listeners today, this deep dive into the reviews of Ofwat's initial thinking about how much it costs water companies to get investment has turned up some pretty big signals.
Red flags almost.
Yeah. And these signals suggest that the real cost for these companies to attract that investment, well, it might be lower than what Ofwat is currently assuming. And this potential overestimation could mean you end up paying more for your water bills than is really necessary.
It's a worry. It really does raise an important question for everyone listening. Given how much this WACC calculation affects what you pay for your water, and given all the questions raised by these reports about Ofwat's approach, what other areas of regulation, not just for water, but for all utilities, could benefit from this kind of close, independent scrutiny, to make sure we're getting fair and efficient outcomes for all consumers?
That's a great question to leave everyone with. Thanks for joining us for this deep dive today. We hope this has helped to unpack a complex issue, one that ultimately affects everyone's wallets. We'll catch you on the next edition of The Deep Dive.